Welcome to another episode of Breakaway from the Rat Race. And today I have the pleasure of speaking with Aaron Chapman. Aaron is a veteran in the finance industry since 1997. After he exited, guess what? From a mining, heavy equipment operation, welding, and long haul truck driving. Can you imagine that? Quite a transition. We're going to be talking about that. And since entering the finance industry, his clientele has ranged from those purchasing their first home, building their dream homes, or investing in multiple properties for long-term cash flow. So his expertise is in the more complicated financing situations. And Aaron is ranked the top 1% in the industry with over 300,000 licensed loan originators. So there's a lot of loan originators, and Aaron is in the top 1% of that. He's closing in excess of 100 transactions per month. Aaron Chapman will be talking to us through the fears that the average person has about inflation and interest rate in this very uncertain economy. You want to also make sure that you watch till the end of the show because Aaron is going to have some great giveaway. So make sure you watch till the end. Aaron, welcome to the show.
Thank you, Eric. I appreciate allowing me to come on and talk to your audience.
Oh, my pleasure. I think this is very interesting. There's so many questions around financing. I keep talking about the importance of leverage in real estate. I mean, if you don't leverage, I mean, you're missing the point. So I think this is so important to have an expert that can help us guide through this thing. But first, I must say, I want to make sure that we understand who Aaron is. And I want to understand your change in career, like from long haul truck driving and, mining and all of that to finance. This is quite the transition.
Well, interesting thing. I was at an event one time and there was a guy speaking at the headliner or the anchor speaker, if you will, who also was in the lending industry at one point. He since evolved to owning companies and whatever. He goes, when he got into lending, being a loan originator like what I am, nobody does that intentionally. It's because you can't get a job anywhere else. And like, that's true. Because I went from, you described, I left a cattle ranch in Utah from high school to the oil fields of Wyoming, from there to heavy equipment and truck driving, and then ended up in the mines in northern New Mexico in 1997. When they started shutting down that project because, the ore was getting deeper and deeper and harder to get. So it's time that it was more expensive to keep that operation going than what they were getting out of it. So in shutting down that project, a lot of us were let go. But I thought it was going to be easy for me to get a job because I had such a long history of doing so many other things. It shouldn't be hard at all. Went back to Arizona. I had a wife and infant son there. I would be gone for 13 days. I come home for 6 is what the schedule I had. Wow. And I couldn't find a job to save my life. I got to a point that we were so broke that I was willing to go. I went and I applied for a $10 an hour truck driving job to haul landscape rock. And my wife, at the time I was heading out to apply for that job, she gave me a coupon for free diapers because we couldn't even afford diapers.
Wow.
So I pulled up to that place. I talked to the general manager. And again, he told me I was overqualified. That was a word I was beginning to really hate. And as I'm walking away from there, getting my truck, I'm wiping tears from my eyes because it was just devastating. Again, another thing I can't get. I started up my truck to head down the street to head to a grocery store with this coupon, and my gas light comes on in my truck. I'd never driven far enough to see how far I could go with a gas light at that point. So I pointed myself to the closest place I could find, had a gas station, then a grocery store. I ran my debit card. I get a decline because I was overdrawn, my financial circumstances being what they were. So I rifled through my truck looking for some change or $1 or something. I found a few coins. Then it wasn't enough to do anything. So I closed the door of my truck. I locked it. I decided to wander that parking lot, that gas station and grocery store to see what I could find. And it felt like a couple hours went by. I found enough change to exchange for a couple gallons of gas. I went in and then I got those diapers that corresponded with the coupon. And I don't know if you've ever been in line at a grocery store and the one item you're paying for the coupon. I don't know if you know how that feels, but it was pretty rough feeling that I was having to deal with there. And as a result of that, I wanted to just get out of there as fast as I could. As I'm walking out of the grocery store as fast as I could with head down, somebody recognized me. So he runs me down, starts talking to me. I explained what I just explained to you. He says, "Hey, let's go to dinner." I'm like, "Dude, I couldn't afford to go out to dinner." He goes, "No, I got a gift certificate for Red Lobster from some clients. I'll take you and your wife." So within a couple of days, we went with him and he told me about the mortgage industry. He shared with me the business card of a branch manager of a broker shop that was local and encouraged me to call this guy. He had already set it up with him. So I called the guy. I finally got another job to run heavy equipment. I called this guy to find out what we could do. And he invited me to come down, and I cut a foot off of my hair. I shaved. My mom bought me some business-like clothes. I went in there and interviewed. They started me as a telemarketer in December of 1997.
Oh, wow.
So
Wow. Incredible.
I couldn't find anything. I mean, I was still looking for another job. The job I was doing when I called him from the equipment was just a 2-day thing. That was it. Just fill in a gap for somebody. They didn't hire me permanently. But then I got a job driving truck over the road. So I go to Sacramento and back every week, then Vegas and back, then work in the office 3 days, doing Friday, Saturday, Sunday, trying to build a business. That wasn't working. So I went back to heavy equipment. I found another job. I'd get to the yard by 3 a.m. I get the job site by 4. I'd work till noon. I'd go home. I'd change. I'd get to the office by 2. I'd work till 10 every night. I slept 4 hours a night for a year before the interest rates went below 7% on owner-occupied loans. When it did that, we had this barrage of refinances, and I was able to replace my income and get into this business full-time in 98.
Wow. That still didn't take that long. I mean, you started in 97, and then in a year, it took you a year to get into a situation where you could really do this full time. And so,
I mean, and my costs were really low. My costs were very low at that time. So that's how we were able to pull that off. But it wasn't easy, man. It was
Oh no, trust me, it doesn't sound easy. That's for sure.
Well, and the thing is now, like you had said, nearly 25 years later, I'm ranked number 20 in the United States. It's the top 1%. I'm number 20 for transactions closed of those 300,000+ people. That doesn't come just by getting up in the morning and making a couple phone calls. You got to work that out. And what people don't understand is it takes a lot to earn it. It takes a lot more to keep it. It is a very, very tough thing to maintain that position because people are gunning for you all the time.
Yeah, exactly. Yeah. So let's talk about the fears people have about inflation and interest rates. So it's a very weird economy right now. As the interest rates are going to go up now. The inflation was down to 0 last month. So a month before that it was like 9. The interest rates the Fed rate is going up. The mortgage rates are heading down a little bit because of the 10-year Treasury. So what's going on? It's one thing when you know that the signal is going in one direction, but now we have kind of like mixed signals, in my opinion.
It's quite the mess. So if you don't mind, do you have the ability to give me a share screen? I'm making me co-host, and I'll share with the people watching and listening a little bit of data of what I'm seeing here. Because when it comes to inflation, and it comes to interest rates, that seems to be on everybody's mind. Everybody is very, very interested in how to do that, or at least what's going on in there and how it's affecting them. So for me, I'm trying to help them understand that it doesn't affect you the way you think. So is the ability to do that would be going into the participant.
I got it now.
Very good. Cool.
No, I'll do it the other way.
So what to kind of keep a little bit of the data happening here, there's a site that I encourage everybody to go to. It's called shadowstats.com. It stands for Shadow Statistics. There is an economist by the name of John Williams that created this site for people to understand more about inflation and other things in economics. You go into the drop-down menus under alternate data, scroll down to inflation, and you'll be able to get to one of these particular graphs that I'm showing you here. Now, what this represents is the CPI and the actual rate of inflation. Now, the CPI, as we can see back here, both lines, there's a red line, there's a blue line, they were converged back in the 80s. And then you start to see a divergence. The question is, why the divergence? Well, the CPI that we're usually getting inflation numbers from is the Consumer Price Index. It's an index. Now, we know that when you look at the stocks, people track 3 different things mainly, right? The Dow, the NASDAQ, and the NYSE, correct?
Yep.
Their values are not the same. How they trade and whether they go up or down by what percentage is not the same. Why? Because they're all made up of different things. The Dow is industrials, right? You got the NASDAQ's more your technology, all that kind of stuff. So when you start looking at it that way, you start understanding it's all a matter of what's stacked into it. The CPI is no different. It's different things stacked into it to see how they adjust with price changes. These things that are within the Consumer Price Index are things that can be easily manipulated with monetary policy. So that's why the Fed follows their stack of goods, not all the things we spend money on. So if you follow this blue line that's referenced here on shadow stats, that adds everything back in that they took out to show that our real rate of inflation is not 8.5%. It's closer to about 17 to 18. So it's important to understand that our inflation is much higher than what we're seeing. But we're still at what has been determined as the highest inflation over 40 years, correct?
Yep.
You probably heard them talk about that. Well, here's what I ask my clients who freak out about interest rates going up as much as they have. Why is it that, what was the interest rates 40 years ago? Let's take a look. 40 years ago, it was 17 to 18%.
That's when I bought my first house.
What interest rate did you pay?
I think it was like 15% when I bought my first house.
Yeah, so 15%, that would have been right around that 1985. So this is owner occupied, right? So we can see we were above double digits up until the 90s. So what people fail to remember that we were double-digit interest rates up until the 90s, right? And inflation was not near as high. If we go back to that, back in the 90s, look at this, where it was. Inflation, according to the CPI, was low at that point. So why were we using double-digit? As far as rates are concerned. So remember, the rates we're getting now is a gift, an absolute gift in that respect. The other thing, the federal fund rate, people talk about that a lot. So do you know what the current federal fund rate is, Eric?
Oh, I forget.
It's 2.5. Just as of this last raise in the rates, 2.5%. Now, people are freaking out. The Fed's raising it 0.75%. That's such a huge jump. Well, what happened back in the 80s? This was Paul Volcker when he was running it. It was 20%.
Yeah.
You'll see, look at this raise from 15 to 19 overnight. That's 4 points on a rate raise. It's crazy.
Yeah, no, that's what I keep reminding people. I said, oh no, but they cannot increase it that quickly. Oh yeah, they can. I said, just look back. They can certainly increase it by 2% if they want to, 3%. They've done it very quickly before. So don't expect that, or they can only do a maximum of 0.5%. No, it doesn't work like that. They're going to do what it takes. Yeah, exactly.
They will do whatever they feel is necessary. But the thing is, I don't feel that they're going to do a lot like they did back then. And the reason I don't believe that they will is more to do with the fact that we have all these other things that are happening, right? We have the supply chain issues, things that happen with the pandemic that's keeping costs kind of low. And so that I want people to be aware of is where we're at with what interest rates were compared to where they are now and where they really should be. Have you ever heard of the Taylor rule?
No.
So the Taylor rule says that you need to take the current rate of inflation and you need to take and then take the target rate and take the difference. So if the current rate of inflation is 8.5% and the target rate is 2%, there's a difference of 6.5%, right?
Yeah.
You need to take that difference of 6.5 and cut it in half, right? So that'd be 3.25%. So you cut that in half, and then you add that all together. So you take 3.25, you add 2, so you're at 5.25. Then you take 5.25 and you take the 8.5 and add that to that. Now, what does that put you at? You're at 9, you're at 14%.
Yeah.
That means they should have the federal fund rate at 14% to be able to slow inflation. We're not there. They're not following the Taylor rule. So I'm telling people now, you better take advantage of what we got while we have it, because I have no idea what they're going to do. Nor does my crystal ball tell me anything, right?
Yeah.
So the question I have, we have been programmed by somebody to think interest rates is the most important thing. Who do you think benefits the most when interest rate is the most important thing in the deal?
Banks.
The banks. Why would you think that?
Because that's how they make money.
It is. Now let me show you how these sumbitches make money, which is exactly what we're going to get into. So have you ever looked at the amortization schedule on a 30-year fixed mortgage?
Yeah.
What does the first 5 years look like?
Well, you pay a lot more in interest than you pay in principal, and then it kind of like shifts around until the end where you pay mainly principal and then less in interest.
Yep, but it's very, very heavy interest up front, right? So what we have, an example here, this is an actual amortization schedule from a person with a $120,000 loan. That person was paying $719.46 per month every month for 48 months. We also have the starting balance of 120 and what the balance was at the end of those 48 months. So $34,524 was paid over 48 months, but the balance went from 120 only to 113,537. That means only paid down the balance by $6,400. Where did all the money go? It went to this heavy interest side, correct?
Yep.
Tons of interest up front. Now, this is traditionally when you start seeing people getting all the emails and all the information saying, you need to refi, the rates went down, you need to refinance. So then what happens? Yeah. This person goes through the refinance process. Now, let me tell you, when refinance start to happen and people are calling like crazy, it's the busiest time of my career because I'm trying to tell them to stop, slow down. Don't refinance unless you're pulling cash out. No. The bank says if the rates go down 1%, you should refi. Why are the banks saying this?
Yeah, exactly.
Because they get to set you back in this heavy interest period like this. Now, take a look at this. So these are the numbers we started, showed you the 34,000. Right? Here's the actual math. So you can believe me, you guys can pause it and take a look at it, make sure I did the math right. Now, here's the deal that we did. He had that $120,000 balance, paid it down to 113 and change, but he had a payoff still, right? So when we got the payoff and everything is ready to go, his actual refinance was 114,642. Then he had to have closing costs, prepaid items, which is taxes and insurance, and then the lender fees, title fees, and the appraisal. When you add it all together, he's like, just add it on the loan because that's what everybody does.
Yeah.
New balance on his loan is $119,833.96. That's $166.04 off of where he started.
Yeah.
Right? Starting over practically. Now, what if they convinced him to do this every 4 to 5 years? Where's he going to be at in 20 years?
But yeah, he's just going to be still paying interest.
Yeah, he's pretty much in the exact interest heavy spot. He owes what he started at. And when you look at the numbers, he's paid out over $180,000 in payments, but he's at the exact same spot where he started. You can't tell me that this is being done to benefit the people who are buying houses.
Yeah, no.
And that's why I think that it's important for everybody to understand what they're getting into when they're listening to a lender that's encouraging them to start to basically keep refinancing. And it's amazing how many lenders that will actually look at this, look at what I'm talking about here, and they'll fight back with me. Like, no, it benefits the clients. They got lower payments. Of course, you're going to say it benefits the clients. You're going to say it benefits the clients because it benefits you. So let me ask this.
I mean, the only thing I do is for refinancing, I think it's good if you're taking some cash out of it, and then that cash, if it appreciated at a certain rate, and you get some cash out of it, 100%. And then you can reinvest some more.
100%. That's the only time I encourage refinances.
Okay. Yeah.
Refinance, take the cash, buy another property. You literally took somebody else's money and you doubled your holdings with it.
Yeah.
What's funny is your holdings are your holdings, but none of that's your money that's tied up in it. People keep thinking, but it's debt to me. No, it's not. You have 2 jobs as the CEO of your real estate investment business, and 2 jobs only. Find the right people to work with, both on the real estate side, the lending side, the insurance side, and all those other things. And then buy the right business, which means the right asset that you can keep reasonably rented for the entire time you own it, and you can raise rents on. If you do that, you win. And let me explain how. Let's just use some general numbers. Let's say you're buying a house for $100,000 and you're putting 20% down. You've got, say, $150 a month in cash flow, and you've got a 30-year fixed mortgage, and you can raise rents by 3%. That's all we're going to go off of here. It's pretty simple. So if you're buying it for $100,000, you're putting 20% down, what dollar amount leaves your bank account at closing?
The $20,000.
$20,000. That's your investment, right?
Yeah.
And that means you're going to finance what dollar amount?
$80,000.
$80,000. And if you did the job I told you your job is, which is to pick the right people and you pick the right property, you keep reasonably rented for the entire time you own it, you can raise rents on, who pays off the $80,000?
The tenant.
The tenant. So let's do some quick math right now. Let's take $80,000 and let's divide it by 30, because that's how many years it's going to take your tenant to pay off this mortgage for you. So if you don't mind running that for me, Eric, run at $80,000 divided by 30 and tell me the exact dollar amount that you get. So that way everybody else can see the reason we're doing this math, guys, is not to test Eric's math skills. It syncs up our brains. We get to where we're thinking about the same things and understanding things, and we zero in and focus. So what number did you come up with?
$2,666.67.
Yep, $2,666.67. Now, we're not done yet. Don't close that calculator. So that's how much is averaging over 30 years, the tenant is paying down for you. Again, it's an average. There's an amortization table. We've talked about it. We're talking about the average of 30 years. Now, hit your divide button on that dollar amount you just did.
Yeah.
And type in 20,000 because that's your investment. This will show you how much your investment's growing by percentage-wise.
13%.
That means your investment's growing by 13.33% every single year. Your 20,000 grows by 13.33% of the original 20,000 every single year. Check my math. Now, there's a few smart people out there saying, damn it, Chapman, hey, you didn't talk about the closing costs. I'm going to walk in there not with 20 grand. I'm going to walk in there 26 grand, right? Yeah. Closing costs and prepaids and all those things. So, Eric, let's do that number again. $2,666.67, and then hit your divide button and put in 26,000.
10%, 10.25.
10.25%, guys. Even with your cost, you're still making an average of 10.25% on your money before cash flows, before appreciation, and before any tax benefits. You're already outpacing every other investment that you have. So where's the argument here? You got one job to do. That's it, right? Pick the right people and pick the right property. So let's set that on the shelf. That's where your growth is. Now, we get to raise rents. Right? Do you know what the national average of rental increases are in the United States right now, Eric?
I think last year was like 11%, I think, something like that. National
11%? Yeah, it's actually about 12 is what I last saw. 12% is what we're seeing in the United States. So does that what we're going to use is we're just going to go off a very nominal number of 3%. So let's say you're renting this property out. You're getting, let's say you're renting it for $1,000 a month, just for round numbers, and you're getting only $150 a month in cash flow. Seems very, very reasonable to get $150 a month cash flow.
Yeah, it is. Yeah.
All right. So then you get to raise the rents by 3%. What's 3% of 1,000?
3% is 1,030.
Yeah, so $30.
Oh yeah.
You're right.
You just the 3%. Yeah. Okay.
Yeah, so it's $30. Yeah, I mean your math worked. It was perfect. So $30. Now that means conceivably, I know that taxes and insurance can change, but we're just throwing raw numbers out here, guys. I'm giving you stuff to think about. I'm not trying to get perfect with this, right? But that means conceivably your $150 a month cash flow could go to $180 a month. So take 30, Eric. So take 30 and hit your divide button, and then divide that into the 150. Now tell us what percentage your cash flow grew by.
20%.
20%, guys. Every time you raise rents, look at the compound growth you get in your cash flow. Your cash flow goes up by 20%. The next year you raise it 3%. You're not raising 3% of the original rent, it's 3% of the current rent. So you're seeing it compound bigger and bigger on your cash flow. Now, I also know your property manager is going to get their little piece of it too. So it's not a perfect compounding 20, but you see where I'm coming from here.
Yeah. It gives you a good, Yeah,
100%.
This is the thing too, is that a lot of people are they get stuck on the numbers and they get, well, it's not exactly right because there's that, there's this, there's that. But this is kind of giving you, these are rough numbers to kind of give you some kind of order of magnitudes of where things are heading, at least. Yes, it might be a little bit off. It might be a little bit lower when you include every little details, but in general, it gives you the right direction.
It gives you the general math to work off of.
Exactly.
Because ultimately, what we're trying to show you, there's more than just a cash on cash return here. Too often the real estate side of it, sales side of it would go off a pro forma and show you the first year and give you this cash on cash return model. Great metric, but to me, it's the least valuable metric in the entire process. That's what you use when you're flying by a market at 30,000 feet in Mach 2 and you see something that just catches your eye. That's to stop, park the plane, go look at the deal and look at the real details of it, like what we're talking about. Cash on cash return model, in my opinion, was something that we painted ourselves into a corner with to sell because it was easy. Now it's working against us.
Yeah,
it should have worked against us. We should have never made that the sales point, right? It should be all these other things. So we know that you get this compounding growth in cash flow, and you're getting the compounding decline in the balance, therefore the compounding increase in your deposit. So far the investor's making money all over the place, right? Does the lender get to raise the payment on the loan to pace inflation? No, they do not. Let me show you something else here that's kind of sexy. So what I have here, because people talk about this being a hedge against inflation, I'm the first person to put a number to it. So I was talking about this on a podcast and theorizing about what a person really pays over time. And the professor of accounting at Kennesaw State University reached out to me and says, you got to come speak to my students. And then he created this tool. And in this tool, we can see, and I did this tool for a client. Now, so I'm showing you guys to take a look at this, is buying this property for $147,300. This is a real deal. Pay with $117,840 loan amount. He was getting a 7% interest rate because our rates went that high recently. They've come back that were quite a bit lower, but it went there. His rent was $1,185, just barely over a 1% rent to loan ratio, well below the rent to value ratio, right? So his payments were $783.99 for a total over 30 years would be $282,237. That's what he would pay. He'd pay back $117,840 principal plus $164,000 in interest. More interest than what he borrowed, right?
Yeah.
But inflation is eroding the dollar every single year. I'm factoring in right here 8% inflation. And with 8% inflation, the dollar's losing 0.666% of its value every single month. So as you're paying back the lender over that 30 years, you're not giving them the $117,000. You definitely give them the $164. The value of all those dollars is equal to $106,845.23. Who just won?
Yeah. Well, we win because we're getting today's dollar at, with the full purchasing power, and then we're repaying the principal over a long period of time where the value of the purchasing power of that dollar is going to go down. So that's 100%. The advantage. Yeah.
One of the other things showing here, raising the rents 3%, starting at $1,183, raising it 3% per year. Look what we end up with. Total revenue of $665,000. Again, your revenue is $665,000. The payment out from the tenant's money is $282,000, and the actual dollars going to the lender is $106,000. You can take pieces of that $665,000 and invest it and compound that. So that's where a lot of people, I think, fail to understand the real value in real estate. So right now, here's one of the other things
this is one of the big reasons why, if you're buying rental properties right now, you must leverage, because in a high inflation environment, this is critical. If you're buying it cash, if you're buying the rental property cash, well, your cash is in that property, and it is gonna appreciate, but it's also gonna, the inflation is gonna be affected by it. The leverage, getting a mortgage on the property is fantastic because you're getting the full money today with full purchasing power, and then you're paying less when you include the inflation. So leverage is very, very important here if you want to beat inflation.
100%. And one of the things to kind of hit on that thought process right there, Eric, is if you took $100,000 and you bought one property for $100,000 and you rent it out for $1,000 a month, you'd make about $750 a month in cash flow. When you raise that 3%, that $30, you went from $750 to $780. What's your percentage increase? I think it's a 4%. It's a 4% growth in your cash flow instead of 20, right? You've taken that same 100,000, put it in 4 properties, making a 20% growth on 4 instead of a 4% on 1. You got to think about that. You also have the 4 tenants paying down the balances on 4 properties, giving you that 10.4% or 10.25% we talked about earlier, when you're not getting that on the other. You're completely losing by shoving it all into one place.
Oh, absolutely. And then you have the appreciation. You have 4 houses that are appreciating instead of only 1, and all that kind of stuff. So yeah, absolutely.
100%. So let's take another quick look here at interest rates so people can wrap their head around something. Here's what the average rates were since 1971. Now, this particular spreadsheet that I've got, I can give you guys the full spreadsheet if you want it. Just shoot me a message. I'll get you the whole thing, this tool, so you can see all the rates all the way back to 1971, tracking the 30-year fix for owner-occupied. This has 2,677 lines on this spreadsheet. The average interest rate since 1971 to now is 7.77%, basically.
Oh, wow, that's very interesting. Yep.
Up until 2009, when they started quantitative easing, the average interest rate was 9.1%. But then you start factoring in quantitative easing, where they $1.25 trillion into the market from January 2009 to March 30th, 2010. And then you look what they did, the pandemic, which was $1 trillion in 10 days. From March 20th to March 30th, and they've continued to put in billions of dollars every day in between all those numbers. Those have put a artificially low interest rate that has never happened in history. I doubt will ever happen again. It shoved inflation through the roof. So Looking
Yeah,
at
that's
this,
why a lot of people are looking at the interest rate and say, oh, the interest rate's so high. It's not high. This is like normal interest rate. This is where it should have been. It was
exactly.
what was abnormal is the 2% that we had before. That
Well,
was
what's
abnormal.
abnormal is still the rate we have today,
Yeah, yeah. Well,
about
this is
6
an
point.
interesting, this is a very interesting figure, like the 7.7 percent average between 1971 and 2022. I think that's very interesting.
Very much. In
Or
fact,
yeah,
like I was saying before, in 1998, when the interest rates dropped below 7% for owner
yeah,
occupied, did I get really busy?
yeah,
That was an anomaly. Nobody ever seen it like that
yeah,
before.
yeah.
We got into the fives in
Mhm.
the mid 2000s. That was ridiculous, and then it went
Yeah,
back up where the
yeah,
average investor was paying like 9%.
yeah.
So what I want people to understand is, guys, this is amazing rates right now. You need to be happy
Mhm.
about that.
Yeah.
What some people are calling me right now and saying, hey, should I get an arm? All these people tell me I should get an arm and I can refinance when the rates go down. Who says they're going down? The only time they've been lower than this is when the Fed started messing with it, and the Fed has just said more than once, we're not going to mess with that anymore. They're
Yeah.
divesting of this, guys. You need to understand they're not buying back in. So don't put yourself in a position where you're hoping that the rates go down. Hope is not a business strategy. Control what you can control for as long as you can control it, and you can control it with a 30-year fixed. So
Yeah,
here's what
even if you have, yeah, even if you have a 30-year mortgage, you can still refinance. In 5 years, if you think the interest rate goes down to like 2%, you can
100%.
refinance. There's nothing preventing you from doing that. But the problem with the arm, if you go like a 5-year arm or something like that, then you are forced to to refinance in 5 years. So, if the interest rate at that time is like 15%, well, you're going to be there. So
Agreed.
I'd rather have options.
Yep, and you're always going to have options, and it's all going to make up for itself anyway because you're buying again an asset that's going to be able to raise rents on.
Yeah.
So here's what I promised you guys: get out your phones, get your camera on. This is the first time I'm going to encourage you to get the phone out. Get the QR code. It's going to encourage you when you download to give me your name, your email address, and your phone number. Don't BS me on this. Give me the real data because we're working on some updated versions of it. And let me show you what you're getting with this. Some of you won't do this. Every time I step into an audience, I show this, and about 30 to 50% pull their phones up and they do it. I show them the details of it. The rest of those people get their phones out and they get this app. So here's what it's called. You're going to get this thing called the QJO Investment Tool. The reason it's called that is called the Quit Jerking Off Investment Tool. Why? Because anybody who's worried about rates and cash on cash return and cap rates, you're jerking off and you're not looking at all the details. So you're going to go into this. This has 4 calculators. We're only going to talk about this one here, which is the mortgage amortization calculator. All these calculators, except this one, are ones that underwriters use. That's why I'm giving you these calculators. No other lender is giving you this calculator, just us. But this one, no other lender has, which is the mortgage amortization schedule I'm going to show you. So you click on that. We're just going to put in these numbers for now. Got to put whatever your down payment percentage is, the dollar amount of your purchase price, whatever rate you're going to do. I have additional payment in there. Don't put that now. That's just you can play with what putting more money into it every month will do to the balance and how inflation affects it. So you're going to calculate that. You're going to be able to see your principal, your interest, and your total payment. You're going to want to scroll down to see the total payment you're making and the current loan balance. Then you want to go to the upper right-hand corner, which has a calendar icon. You click on this. They'll show you this year. I'm showing you every year on the anniversary of the closed loan what the balance looks like. You're going to scroll all the way to the right to 2052. You can do any year you want, but for this purpose, we're just going to go to 252, and we're going to select and close. Now you're going to see the total payments to date, which is $273,053.39. But after inflation eroded that dollar, and I'm factoring this at 8%, it's $103,368.53. Now you get to see the power of this. Now, what's also really powerful here is we use this inflation-adjusted payment versus the payment. This means if you bought $69.36 worth of stuff today, it would cost you $758.48 in 30 years. Reason I know that is when I was a kid, I'd go down the corner store on my skateboard with a dollar bill from my mom, buy a gallon of milk, a candy bar for me, and come back with change. How possible is that right now, Eric?
Exactly.
Yep. So that's how I know that what's going on with inflation. Now, for those of you who didn't get out your phone, there you go. Go ahead and get this, register, get that. We're going to get you updates on this. I want you to be successful in what you do. And I'm giving you the tools to be successful because if you start to fail, I'll eventually start to fail and I get really violent against failure. You need data on how to use this calculator. Here's how you get a hold of me. Just get to aaronbchapman.com. aaronchapman.com works. You can just Google Aaron Chapman. You'll find only one bald bearded redneck lender on there. And this is how you get in touch with us. Set up a time for us to talk.
And that's true. That's the only bald-headed, bearded lender that I know. Well, that was very good, Aaron. So thank you very much. I really appreciate the time that you spent with us, and really kind of like, really show people that this is really the place to be, and don't be afraid to use leverage and to get invested in real estate properties. I mean, this is very important. And now you know the bearded lender, so you can get great loans and on rental properties and all of that. And I also like in your discussion too, kind of like how you are, you kind of like just the rough numbers. It's like, this is what it looks like. This is, your investment is not just cash flow, cash on cash return on your net cash flow. It's also appreciation. How does the appreciation affect that? How does inflation affect that? How do your rent increase affects that and stuff like that? And really show now that, and we haven't talked about taxes and all these impacts as well. So I think this is fantastic. So thank you very much for all that information. And I'll make sure that I put all that information in the show notes also. And so thank you very much.
Very good. Thank you. And if you guys also, you can go to my YouTube channel, just look for Aaron Chapman. I have twice a week, I give a breakdown of what's going on in the market, how it affects you as a real estate investor, and how to read the mortgage-backed securities charts. A lot of times people talk about the 10-year treasury is what they focus on, but sometimes they go opposite directions, right? You've got to know what's really driving the market for interest rates with loans, and that's the mortgage-backed securities. If you want to understand mortgage-backed securities, watch the movie The Big Short. It tells you about where it came about, how it started, and then what happened in 2008. So Thank you for allowing me the time on to talk to everybody. And thank you guys for reaching out to me and getting the app.
Yeah. Thank you.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.